trading at its best.
Welcome to the Forex Weekly webinar today. For those of you that are first-timers, I am Mike Swanson, been trading the markets for 10 years and been teaching traders for about 5. And I've built lots of different tools and systems and strategies that you've probably seen on my blog. Today I've got a lesson that we're going to go over that's another kind of basic one, but I'm going to give you some examples that I think will apply to all levels of traders, so stick with me today. And the topic of today is hedging really necessary? Thought this would be a good one to kind of crack down on and get to the bottom of it. So we'll talk about today what is hedging in Forex. We'll talk about how it works, get into the nuts and bolts of what exactly it is, and then we'll answer the question, should you hedge or not? Okay, so let's go ahead and talk about what is hedging in Forex. Now, those of you that have been trading for a while should understand what this is, but it's basically holding a buy and a sell trade at the same time on the same pair. So some of you are probably that are new to this are probably wondering, why would you do that? You know, why would you trade against your own position? You're not going to make any money or lose any money. Well, what traders are doing that are hedging is they're using it to pause their profit or loss during a reversal. So if the market's going up and they are selling, they might buy to temporarily hold the position until the market turns back in their favor. And that's just one angle that traders have used. Okay, so that's pretty straightforward. That's all the explanation I'm going to give you on what is hedging. That's the basics. Now let's talk about how hedging works. So I've got this graph here, or this chart, that we can kind of walk through together, and I'll show you an example of how a hedge might work. Okay, let's say you're over here and you've taken a buy trade, or I've got this blue arrow. Okay, so you've taken a buy trade right there, and you went ahead and took it with one lot. Okay, let's just say you took it with one standard lot. Now, the market is obviously going against you. The market's turning down, it starts heading down against you, and what a hedge trader is going to do is at some point they're going to want to sell and hedge that buy trade from further losses. So right here I've put in a trade that someone might have sold right there. It locks the trade so that you're not losing anymore, but you're not gaining anything. Okay, so we'd have to sell one lot, just like we did over here with the buy. That's going to lock it. Okay, so we've locked it if we sell one and buy one. Okay, then the idea is supposed to be that at some point you're going to unlock the hedge, unlock that sell trade, and close it off. So I went ahead and said, okay, let's say we closed it down here at the best price, best possible place. Okay, so you close that off, and that's going to result in, let's say, a $100 gain. So you took a $100 profit on the sell trade. Okay, well then, you've still got your buy trade open. It has a floating loss at that time. Okay, well, when the market turns back up like it did here, at the top, let's say you closed it out and you took the profit on the buy trade. And let's say that's a $200 gain. Well, you see now hedging shows that, okay, well, you were able to cover a $100 gain on the reversal, and then a $200 gain when the trade went back in your favor of your initial position. So that's supposed to be the idea of why hedging is so great, and a lot of people get upset when they hear about brokers that don't allow hedging. Well, let me show you. Let's move on now to should you hedge or not. Let me show you that it's actually not necessary to hedge. Okay, let's walk through the same exact trade, but without hedging this time. We're going to do the exact same decisions. Okay, oops. So here you are. You took your normal buy trade, just like the other example. You took your buy trade right there. You took your one lot. Okay, but now right here, instead of actually hedging and selling, what you're going to do is just close the trade off. You're going to take a loss. Let's say it's a $100 loss. Okay, you close it off, you take a loss, and then what you do is at that same place that you were going to plan on closing your sell trade, okay, normally you were going to close your sell trade over here where I've got that blue arrow drawn. Okay, instead of closing a sell trade, you don't have a sell trade. So what are you going to do? You're going to buy here. Okay, normally you were selling and you were closing at the sell. We're just going to buy here. Okay, now you've got a buy trade, and you're going to ride it up just like you would have held on to your original trade. You rode it up and closed it off out here. And that would have resulted in a $400 gain on that buy trade. So if we look at this, that's a $300 gain, exactly the same as the result from the hedge. Does that make sense? So I've just shown you that you don't necessarily need to hedge. Okay, the reason I think traders hedge is it's got this psychological benefit maybe, where basically they might not have normally gone in and bought again right here, but if they had a hedge on, they'd be watching the market for a place to exit that sell trade. So what you've got to do if you can't hedge or you don't want to hedge is you've got to train yourself to act like when you closed that trade here, you got to make it look like you did take a sell trade. You could just take put a note on your chart and kind of pretend like you sold there, because it's really the same thing at the end of the day, like I've demonstrated here. Okay, but pretend like you sold there, and then at some point you got to find a place to buy, and that's what I've done here, and you've got the exact same result. So hopefully this short little lesson has opened your eyes about hedging, that it's not really that big of a deal. Maybe there's that slight psychological benefit, and it's something that I might build into my Informer tool to help you, take that virtual trade or kind of do a virtual hedge, and that's something we'll look into for a feature we can add to my tool down the road. But this shows you don't need to hedge. You don't have to worry anymore about needing to hedge. Just let your trade get closed out. Let it close out and then re-enter where you normally would have closed the hedge. And it's the exact same thing. So hopefully that short little lesson has helped you guys. And we'll go ahead and take some Q&A now, and we can go into more detail on this if we need to.